Hi, this is Abhinav, and in this video, I'm covering US tax traps that Indians who are moving to US they need to know. Now, there are a lot of such tax traps. From whatever I could think of in this slide, I have put it, but since there are many, so this I just named it as part one this video, and then I will make a part two and maybe part three, right? So let us start. Okay, so the idea here is that to make you understand that US is a different country with respect to other countries, many other countries in terms of taxation. They have a citizenship based taxation, and that kind of taxation is followed by US is the only country, and there are few more countries like Eritrea and even Myanmar, which countries impose tax on their citizens and residents. Uh, so that is one big difference in terms of how US taxes its citizens and residents. Plus, US basically has views non-US investments in a very kind of a suspicious light. So they have a lot of provisions which are quite harmful for people who are moving into US and having investments in India. So many times what Indians do, because they get the H1B, under the H1B quota they get a kind of a visa to move to US. They don't know the implications, and then after moving to the US they come to know, and some people even don't know the implications being in US, so they end up making non-compliances in US. And US has a lot of high penalties in terms of non-compliance, US non-compliance, the foreign income or foreign assets non-compliances, right? So the idea here is to make you aware of the tax trap, so that when you make the decision to move to US or living in US, making the decision to maybe obtain a citizenship or a green card and then returning back to US from US to India, you can just kind of arrange and plan your kind of affairs, financial affairs beforehand, right? Do some planning, right? And don't just move without proper planning, right? So let's start. So getting first is, because of the US citizenship based taxation, if you are a US citizen or a green card holder, you will forever be a US person, right? Even if you want to, even if you move to India or you move to any other country, US will keep taxing you as a resident. So you will remain wedded to the US tax system and the associated implications as a US resident if you obtain a US citizenship or green card. Now, I understand that it is definitely not practicable if you want to live in the US for a long term. You don't want to live under the kind of a hanging sword of H1B visa, because if the H1B visa kind of expires, or the employer fires you or something like that happens, then there is, I think, a limited period of like 60 days in which you have to move back to your home country. So I'm not an immigration person, but some kind of those provisions are there which are very highly unfavorable, and provisions that can cause anxiety in a person. So definitely the person may want to obtain a US green card, but my point is that if you go for citizenship or green card, please at least know the kind of implications, that the tax implications that you will expose yourself to, even if you move back to India. So for people who like have a GC or a citizenship and move back to India, not knowing that the provisions of filing a 1040 every year, disclosing the Indian incomes in the US tax return every year, they expose themselves to the non-compliance of US tax law, right? So we don't want to see, as a law abiding person, I want to comply with the tax requirements, tax obligations of India as an Indian citizen, and also the place or the country where I go to. So, if I'm even going to Germany, Germany has its own requirements of. So every country, mostly countries, have requirements of taxing their residents, which US also does. But US has a peculiar system of taxing their citizens and green card holders on worldwide income, irrespective of the fact that they have moved out of US, right? So there are certain peculiarities with respect to US. So always when you move to a foreign country, be make sure before moving to have an idea of the tax regulations, so that you can arrange your India and that country investments in compliance with the both the laws. Then estate tax for non-residents. So if you have lived in US, you've accumulated 401k, made certain investments in US, and then if you move out of US, when you move out of US, you become a non-resident alien as per the US tax law. Now estate tax, US has a estate tax which only few countries have, and US, the estate tax for residents, there is a very high limit of I think 13 million or something like that. The very very high limit is there. Only that threshold, if you cross that, then estate tax will happen. But for non-resident aliens, people who are not US citizens, green card holders, and who are not residents of US, who are non-residents holding US domiciled assets above 60,000, which is very small threshold. Even if you've lived in US for a few years, you accumulate like amounts in your 401k and other investments more than 60,000. And if you're living in India and you die, right, there's an unfortunate death, right, of yours, then there is a very complicated system of tax. It's like a graduated tax of 18 to 40% on the value of the estate, not the income, value of the estate. Plus there are some compliances with respect to filing the estate tax return in form 706, and that return filing and all takes 1 to 2 years, and only after that your family will get the money, right? So you need to be aware of this. So you need to keep your assets below this when you plan to return to India. You can move it to other jurisdictions like Ireland, or you can move the money back in India and then invest in India. Try to keep it below 60,000, right? I'll make separate video on estate tax, how, what are the provisions, how to uh, avoid estate tax. I'm not a US tax expert, but I will try the best of my ability for Indians how they can avoid estate tax. I will make a video on that. Uh, if you are a non US citizen or GC, if you live in India, then you are taxable. The provisions are as for the residents, so you are protected. But I'm talking here about the non-resident aliens who are not USC GC. Now, no estate gift tax treaty or social security agreement with India. So US doesn't have these treaties with India, right? Uh, then even in the India US DTA, the provisions of that DTA, it's a weak treaty. It's not as strong a treaty as India, the US UK treaty or the US Canada treaty, where certain investments like Canadian RRSP and all those investments, US gives them the same recognition as the Canada does, right? But India US DTA, there are no, as I will cover in the further, the lot of tax advantaged accounts that you have in India like PPF, EPF, they will not hold any value with US. US will tax the income every year if you are a US resident, or if you get USCGC, then for the entire duration of your investments, even after you return to India. So you need to be mindful of that. Then there is a savings clause in the India US DTA which basically prevents US citizens or residents from availing certain DTA benefits. So on top of it, it's a weak treaty. Then on top of it, there is a savings clause whereby if you are a US citizen or a GC or a resident, you may not, US may not give you certain DTA concessions, right? So you need to be aware of this, right? Not blindly rely on the DTA, right? Then PFIC, if you hold any Indian, if you're an Indian who is planning to move to US, and if you hold any Indian mutual fund or any pooled type of investments like ETFs, right? You need to read up on the PFIC, Passive Foreign Investment Corporation. I have made a separate video on PFIC. There is a very very onerous tax and reporting requirement on such pooled investments, foreign pooled investments, right? Now there are certain benefits that you can have up to a certain threshold of 25k to 25k 50k. That threshold, if you have, you can still continue to have those investments with proper precautions. But there is a proposed rule also now which says, proposed provision in the internal revenue code, which says that if you are having these investments, and if you're like moving out of US, if you're on the last day of your US residency, it will be treated, there is a provision of deemed disposition, that US will deem that you have sold these assets, and the profit, the tax, US will impose tax on the entire unrealized gain. So the basic provision is that if you hold like Indian mutual funds of 10 rupees and they become 20 rupees, so you have not sold the Indian mutual funds, but US will still every year apply unrealized the amount of income from those investments, like the 10 rupees income, US will tax it as per your tax slabs, right? No, not even as per tax slabs, it is as per the 37%, which is the highest maximum marginal rate in US, right? So this is very, very onerous requirement. Plus you have to, for every scheme of the mutual fund or the ETF, you have to separately file a, form 8621. Now there are final provisions with respect to certain elections, like a MTM election you can make, or there are certain, those provisions are there, which I have covered in that video. So please, if you have any Indian pooled investments, you need to have a strategy to liquidate them before moving to US. Or if you're in US, then you need to take certain precautions so that you do not fall in the PFIC tax loophole, right? So a lot of places I see, they sell the the kind of Indian mutual funds to US residents without telling them of the PFIC tax implications. And by the time the person has invested a substantial amount in the, they always say about the India growth story and all these things, right? So and the people buy into that without knowing the US tax implications, and then they end up with huge liabilities and non-compliances in US. So please take care of that. Then there is this point about the FBAR and Form 8938 reporting. So if you are a US resident, you need to make these kind of reportings. FBAR is like having a threshold of 10,000 USD, and Form 8938 is has a higher threshold. But like if you have like sold a property in India and money comes to your Indian bank account, then you may be breaching these limits, right? So please take care of the FBAR Form 8938 reportings for your Indian bank accounts and investments, right? Not only bank accounts, but also other investments. So please read up on the provisions and make the proper reportings as required by the IRS. The penalty for wrong reporting or willful non-disclosures is very, very high, right? So you cannot compromise on that. Get a CPA in US, preferably someone who has experience in US non-resident taxation, right? Because I've like seen cases where people have their CPAs, and those CPAs themselves don't know about the PFIC and other things, right? You tell them that okay, this is PFIC, and then they do accordingly. So don't do that. Get a CPA. First of all, ask them whether you have expertise in the US non-resident, like Indian investments, right? Not Indian investments, but how to treat the US tax law provisions on foreign investments, right? From a perspective of US tax law. Do you have expertise in that? Then only you hire a CPA, right? And be prepared to pay higher charges, right? Because of the kind of expertise that is involved. Now, IRS has certain compliances like between India and US, like if you are giving a gift to someone, right? Someone giving a gift to you, right? Many transactions are there which require reporting under Form 709, 3520, 8621 is the PFIC reporting, and there are other reportings also. Then if you have any partnership, directorship, interest in India, that is like US use them as a very suspicious from suspicious eyes. So there are certain reportings there that you need to make, right? So please take care of the IRS compliances which are there on various cross-border transactions and investments, right? Okay. Now, if you have returned back to India, you need to file a W8BEN to the US payers of income, which can be a broker, which can be your kind of maybe an employer, right? Or any client in US. If you don't do that, then there is a backup withholding tax that will apply a flat 24%, which is very difficult to claim tax return in India. Now, uh, always, if you also, if you don't provide a W8BEN, then US can apply, the provider can apply a 30% withholding on the FTAP income, foreign, the fixed determinate annual periodic income, which is interest, dividend, and other incomes. Instead of that, if you file W8BEN, then you can get a lower treaty rate of 25% withholding, right? And so if you don't file W8BEN, you don't get the benefit of reduced treaty rates as per India and US. And then if you need to claim a refund, so for example, the provider has charged withhold a 30% tax rate, and whereas the actual tax rate as per the treaty on that dividend income was the 25%, then the only option for you will be to submit a form 1040 NR to claim a refund. And there will be charges for filing 1040 NR also, so which may even exceed the amount that you want to claim a refund. So you need to take care of filing a W8BE and first change all the addresses to the Indian address in your 401k, to the, wherever your investments are there, and give a W8BEN to them. Yeah, 24 backup withholding tax, I've already said. This point I've already covered. Very difficult to claim the credit, as per the near impossible to claim the credit of that backup withholding tax, as per the FTC provisions in India. Then there is, US doesn't offer any step up in the cost, right? So you have any Indian investment, which is like a, say, a mutual fund investment, or take a share like a 10 rupees share, and on the date of you moving into the US, it is 15 rupees, right? So US doesn't offer you a kind of a step up basis, that, and then when you sell it, it is at 20 rupees, right? So when you sell it, the US will tax you on the entire 10 rupees, the difference between 20 and 10 rupees. So US will not say that, okay, we will give you a step up basis up to 5 rupees, and because you entered US, and it was like 15 rupees, then no, US will not do like that. Similarly, India also doesn't give a step up basis. So always best strategy is that before you move, you do some kind of a immigration tax planning, pre-immigration tax planning before moving to US, right? I've made a separate video on planning to move to US. Do these things, you can check that. So what you can do, you can sell and repurchase. You can first let go of pooled investments in India to the extent possible, mutual funds, ETFs, and other investments, right? You, if you hold shares and all, you can kind of sell and repurchase them, considering the MTM position. That means only you do this approach when you have a gain, right? Because if there's a loss in the investment, then it is definitely, please keep those investments, don't sell them, because that loss can be set off against the US capital gains, right? Right. So see the MTM position near to the time that you're making the move to the US. If there's a gain position in the US, in the India, and you can also see the India tax implications, because India also offers up to 1.2 lakhs capital gains exemption, right? So if they are long term, and up to 1 point covered within 1.25 lakhs, you can do a kind of a tax gain harvesting in India, and you can basically sell and repurchase the investment, so that you get an automatic step up basis, which will reduce the US tax liability on these investments in US. So that kind of planning you can do, right? Okay. USA does not recognize. So a lot of people have this confusion that, and similar way, India also doesn't recognize. So US doesn't recognize. So in India, you invest in PPF, which is basically all the income is kind of tax free, everything is tax free, gains are also tax free. EPF, everything is tax free, gains are also, like if you withdraw and you have 5 years more of service, tax free. NPS, so it's basically a tax deferral kind of a thing. US will totally ignore all the tax advantage nature of your Indian investments. So what problem happens is that all your best kind of laid plans, that means all the best strategies you made for your tax planning in India, will all go for waste the moment you move to US. Because when you move to US will tax you on everything: income from BPF, income from EPF, income from NPS, income from your NRE fixed deposits, right? So people think that NRE fixed deposits money is tax free in India. No, it will be taxable. It is tax free in India, but the entire interest is taxable in US, right? So US totally does not recognize. That's why India US is a very weak treaty, right? You don't get any significant protection. Similarly, India also doesn't recognize 401k, IRA, Roth IRA. India also doesn't recognize, right? So it's because of the relations between countries, like US, Canada have a very strong relation, right? US, UK have a very strong relation. So it gets the kind that strong relationship gets reflected in the DTAs also, right? But in India, US, it is not like that. So you need to plan. So that's why the need to plan your finances in that better way, so that you can kind of reduce the, so impact will come, right? But you can, if you plan properly, then the impact can be reduced. Then US gives proportionate credit of Indian tax. So if you have Indian tax, so you may say, okay, DTA is okay, no problem. I will get the foreign tax credit as per US laws. No, please read the foreign tax credit provisions in US. US gives a proportionate credit of the Indian tax. For example, there is a like a 3 rupees of income, Indian income, right, which you want to, which is taxable in US, and you want to claim a credit of that income in US. So you may think that, okay, I will get the entire 3 rupees tax, the income, the tax on that 3 rupees income in US also. No, US will give you credit of the proportionate the tax of that India tax with respect to. So if the total income, US income, which US will tax worldwide income, is 10 rupees, of which 3 rupees is the Indian income, US will give you credit of 3 by 10, that is 30% of that Indian tax which you have paid on that Indian income, right? So it will not be the full credit. Then there are certain states like California which don't give the credit for foreign country tax, right? So then US has a very difficult kind of a system. There is a federal tax which has certain provisions and which has certain beneficial provisions. Then you have the states that impose additional tax, and they do not give credit for certain tax. Like for California, I know is that it doesn't recognize certain tax advantaged investments, uh, maybe I think 529 or HSA, which the US federal tax recognizes. So the tax planning in US is very complicated. It is not only one law. Like in India, you have the Income Tax Act, which is the only one law. In US, there is a federal tax, and then there is a state tax provision also you need to check. So you need to have a CPA in, like if you are moving to California, you need to have a CPA in California who has an expertise of the federal as well as the state tax, and you have a CPA, a CA in India, and and those both professionals are needed, right, because of the complexity. And if you find, if you're lucky enough to find a person who is expert in both the things, then nothing like it, right? Okay, no unlimited marital tax exclusions for any gift. So if you make any gifts, then there is a specific provision that if you make a gift to a US citizen spouse, any gift that you make is totally exempt. However, there is this unlimited marital tax exclusion does not apply to any gifts made to a non-US citizen spouse. So generally, why you gift gifting helps you reduce your estate, right? Reduce your estate from estate tax liability. So you may, someone may want that, okay, person is a US resident planning to return to India in few years, and he generally there is a limit of 18,000, which is a 2024 limit. 18,000 up to 18,000 USD. If you give, then it is not covered in the overall limit for the estate tax. But you can make a gift to your spouse, and that gift to a spouse is not covered in the is excluded from your estate. But for a non-US citizen spouse, there is no unlimited marital exclusion, right? So there is a discrimination there. So generally it is, I think the limit is 1,75,000 USD. That limit is there. So that also you need to check, and accordingly you can plan. Then okay, in Indian who is moving to USA has kind of a Indian home. A person has a home in India, and generally what happens is that the person may decide to maybe settle for a longer term there, or he wants to purchase a house in say California and he wants to sell the home. Then please be aware that US will, so India will tax as per its domestic law. US will also tax as per its domestic law. There is no relief available under the India US DTA. So when US taxes this income, the sale of India home, US generally gives a 2.5 2,50,000 5 lakh dollars if married filing jointly. Kind of an exemption is available if you have lived in the house for 2 out of the past 5 years. That 2 5 year rule is there. So if you have moved to US, and if you have like stayed for a considerable time, like 10 years in US, and then you are thinking of selling your house, then you will not get that exemption. So you need to be very clear that at the time of moving to US, you need to be clear that you need to sell the house within, to claim this 2 to 5 year rule, the exemption of right. So you need to just plan accordingly. Then US taxes you on the unrealized currency gain, which is also known as phantom gains. So basically, there is no gain because US will calculate the tax on the sale of India assets, on the sale of India home, on the USD. So USD at the time of purchase, USD at the time of sale. So if there is a portion of the income from the capital gain, the portion of the capital gain arises purely due to exchange fluctuations. US, there is no real gain. There's only because its gain is calculated in USD and it occurs due to the exchange fluctuation. US will still tax it, right? So you cannot say that it's because of currency gain, so I get some exemption. So please also be mindful of that. So that currency risk is to the extent there, right? When you maybe have foreign investments back in India. Okay. So tax liability of US home, yeah, tax liability of US home. So you have a house in US and you want to sell that house. I will make a separate video on these particular aspects. I'm just covering it here as an overview. So you have a home in US and you are moving out of US, and you are not a resident of US. Still, if you have a home in some states, the states will continue to treat you as a resident and maybe tax you on the worldwide income, right? So you need to decide that if you want to fully get out of the US tax system, you may have to decide on the kind of sale of US home, right? Before or within a reasonable time after moving from US. So check the provisions of the US federal law as well as the state law, right? So that implication you need to keep in mind. And then there is a provision that if of unrealized income taxation provision is there of a US home of a non-US resident, then there is a provision that if that non-US resident sells the US home, then there is a flat, I think 15% tax withholding on the proceeds of the home, right? So that provision is also a very harmful provision, that it's flat 15% of your house that will be kind of the sales proceeds will be withheld for tax purpose, and then you have to then file a 1040 NR and get the refund or adjustment of that withholding, right? So you have to be mindful of with respect to your US home, right? State tax implications you need to check, as I discussed already. There's a not only the federal tax, but you also need to check the state tax implications, not only with respect to your US investments, right? For example, some states don't give the benefit of a HSA, right? Some states don't give the benefit of a 5 to 9 contributions, which whereas 5 to 9 and HSA are very good tax advantaged accounts in US. Some states do not recognize them. Some states do not give credit for tax paid in India, right? So and so and how they treat the Indian incomes. So you need to also check the state provisions. Then accidental American implications is where a person is an accidental American. That means your wife was there in US for some years and you have a child in US, but that child is by birth, he or she gets a citizenship of US, right? And then when you return back to India, so you were on an H1B visa and you did not apply for a GC or a USC, and you return back to India, but your child is still a US citizen, right? And many children, they don't know that they have to still comply with the entire US taxes. They remain wedded to the entire US tax system. So when they become like 18, 20, 25, 30, they start earning their incomes in India. So maybe your son starts a job in India and all. So that income is taxable in US also, because your son is a US citizen, right? So there is these cases of some celebrities and some politicians, like I think Boris Johnson had this thing where all of his UK income got taxed because he left US when he was 5 years old, and he was unaware of the US taxation provisions. Uh, as a birth, you get a citizenship and all. So there was a tax liability that the IRS imposed on him, and so you can read up on this accidental American, right, thing. So you need to decide on that. Okay, so this is part one. Whatever I could think of, I have made a video on this. I hope it was useful. It gave you some useful pointers. I'll make a part two of this video in some days time. I hope this was useful. Thank you so much for watching this video. If you have any queries, any comments, do share in the comment section. Thank you.